Hi everyone and welcome. Just checking you can hear me there, Gareth. Can you give me a nod or say something?
I can hear you fine, Steve. Can you hear me?
I've got you loud and clear. We've always had a pretty close relationship with the clients, but I never thought I'd see the day where we're bringing them into our houses, Gareth. It's crazy times out there at the moment. You and I have both been working from home for a bit over a week now. How are you coping at your end?
I've been working. I've worked out the other day that I worked out at home for all but one day out of the last 3 weeks. So I've been at it longer than you, Steve. Look, it's fine with me. I've been used to working at home a lot when I was living in Vienna before I had my home office. I've got all right structures. It's going to be more difficult once the kids turn up starting tomorrow, but we have a plan B in place with some friends that we're going to take turns babysitting. It's been a lot. There's been a lot of 18-hour days, as you'd know, over the last few weeks, and I found it quite handy being at home. We can rotate, have a nap after lunch, and have dinner with the kids still, and then get straight back to work. So it's been good.
Yeah, I'm finding that lack of separation a bit difficult though. I've been getting up at 5 o'clock in the morning for the end of the US day, and you walk straight to your computer, and then you're heading from your computer straight back into bed at the end of the day as well. That's yeah, I think it's important to try and find some time to take a break.
Anyhow, let's get on with it.
Yep. Ducked outside today at lunch. I think Australians have finally got the message, which is some good news. It was very, very quiet out there and people giving each other very wide berth. So some positive signs there, but it's probably going to be very difficult headlines for at least a few weeks yet based on the experience overseas. Thank you for listening in, everyone. We are very, very fortunate as a business to have the clients that we have. I had a few questions come in prior to this already, asking about redemptions and viability on the international fund side of things. It's been very, very small what we've seen so far, and I think we've got a client base that thinks the way that we do. So thank you for your support, and I hope everyone's healthy and well in your lives. Just want to reiterate as well, I talked a lot about resilience at last year's roadshow, making sure we've got the right fund structure for the type of investing that we are doing, making sure that we've got the right sorts of clients, and importantly, making sure that the Forager business is set up to survive periods like this. Just wanted to reiterate that all of those things are still in place. The business is very well capitalized. The team is out there working hard, looking for ideas and trying to get the right portfolios put together rather than worrying about our own survivability. Before we get stuck into some details, a general disclaimer from me. Anything we talk about today is general advice only. It does not take into account your personal circumstances, and you should seek professional advice where necessary. Gareth, I just wanted to kick off with a few charts showing the magnitude of what we've seen over the past few weeks. It's been a very dramatic retraction in markets, and probably more important than anything, a very violent retraction in markets in terms of the speed with which it's happened.
Yeah, and we've seen some, I would say the averages here are not really telling you the whole picture. Obviously, just about everything is sold off one way or another, but we're seeing things that are fallen 10% and other things that have fallen 70%. So just a really wide divergence, as you would expect at a moment like this in markets.
Yeah, and it's not just equity markets. We've actually seen government bond markets in a state of turmoil. Lots of issues in repo markets, foreign currency markets, all sorts of things happening out there that are obviously related to what's going on in the world, but also very much related to liquidity in financial markets. And been interesting, I've listened to a few things leading up to this crisis, actually talking about stresses in the repo market and just general issues around liquidity because of the response to the financial crisis back in 2009. It's very difficult for banks to take risk on their own balance sheets these days. And the way the regulatory environment works is the more volatile the environment gets, the less risk they're allowed to take on because they all use these volatility-based risk models, and that's what the regulator wants them to use. So we've seen a big retraction from banks in terms of providing liquidity in some of these markets where they're very important. So that's the S&P 500 there, down 32% from where it was just a few weeks ago on the 20th of February. The ASX All Ordinaries down a similar magnitude. It's about 33% from its peak to trough. And to your point about some of the smaller, less liquid things, this is a chart of the Small Ordinaries Industrials Index, which is probably a reasonable reflection of the space that we tend to shop in here in Australia. And you're down 43% there. And the peak was actually sort of August last year in terms of this index. So we've seen a pretty extravagant meltdown in that market there. And if anything, I'd say over the past week or so, it's picked up in terms of the magnitude and the lack of discrimination in terms of the selling.
Yeah. And I think, a lot of people comparing here to the GFC, there's potentially some other metaphors that are better. The 1987 sell-off, for example, like this is the first time in my life I've experienced this abrupt a change in 1 month.
I think that's right. And I think some of the, financial crisis issues around access to funding, we may see, but you've seen a very, very rapid central bank response to that. And the banking system is much better capitalized than it was and much better able to provide that credit through to businesses that need it. It's quite a different type of crisis because you're sitting there as a business. It's not a lack of funding that's stopping you from doing what you're doing. It's a lack of demand for your product. And there's a lot of businesses out there that are shutting down. And I think on the fiscal side of things, we're starting to see more of a reflection of that. I don't think there's any point in providing a business with easier credit conditions if it doesn't have any customers. Yeah. It's not going to open its doors and employ its staff, no matter how much credit you give to it. So I think some of these responses are...
biggest demand drought, surely in the last 50 years, right? It's the financial crisis. A lot of people had tightened wallets, so they didn't go out. But now you're literally restricted, even if your wallet's filled with cash.
Yeah. So look, it's been pretty wild in some of the more liquid securities out there. Like I said, government bonds, but even in the stock market, some of the big stocks have moved around violently. But look, at the small cap end of the market, I'd say it's bordering on dysfunctional in terms of the lack of liquidity that's out there and some of the price moves. I just had a quick look at the ASX All Ordinaries Index for today and its constituents, and you can scroll down to number 25 in the index in terms of the worst performers for the day, and you're only at 25% down. You can actually get the 50 stocks have dropped more than 20% in terms of their move today.
So the average or the 50th has moved 20?
The 50th stock is down 20, and so there are 49 that have performed worse than that. So yeah, we've seen some pretty dramatic moves, and I think you're also now starting to see some more forced selling come through the market as well.
Yeah, for sure. And I think we're seeing that globally, and particularly, I would say, in the Aussie small cap space, right?
Yeah. Our fund has been particularly hard hit in terms of its NAV. It's
sorry, you mean the Australian fund, just to clarify?
Sorry, the Australian shares fund. You've got the All Ordinaries Index. This is just the month of March. The fund is down something like more than 40% in terms of its net asset value. That was as at close Friday. You can expect that number to be worse when we report the NAV tomorrow morning, and the ASX All Ords is only down 25% over that period. Look, I'm going to talk as we go through this quite a bit about some of the underlying securities, and I think it's an environment, like I said in my letter to people last week, where it's really, really important that you focus on what's happening with these businesses that we own rather than the daily movements in prices, because there's going to be more extremes than what we've seen already. I wrote in that February report about NZME trading at 3 times earnings and how I thought that was a crazily attractive price for a business that has been holding up its profitability reasonably well. As we've seen since, there's nothing stopping 3 times earnings going down to 2 or even lower than that, particularly in
especially as the earnings are under pressure, right?
That's right.
Look, I mean, just on that matter, the forced selling here, it seems pretty clear that there is liquidations going on around the world and in Aussie small cap. What are you seeing specifically there in Australia? Yeah,
I mean, I'm hearing a combination of people that just don't want risk at the moment, so they're not necessarily forced, and other people who are more forced. A couple of interesting anecdotal things. I got sent a whole portfolio by a broker on Friday saying here's 30 stocks in a portfolio. Are there any of them that you're interested in? Now, that doesn't mean it's a whole portfolio going into liquidation, but I think we are going to see that. And the other thing, and I've been tweeting about this on and off for a bit over the past year, but a friend of mine who works in a super fund administration business was telling me that their requests to shift their allocations from people in the underlying super funds from aggressive or even balanced and into cash in the super fund have been 6 times what they normally are in the business. And he's never seen a volume of switch requests like he's seen at the moment. So think you're seeing some of that flow through as well. You've got a bunch of super funds out there that are saying we've got all these long-term assets and we can therefore invest in infrastructure and illiquid assets, and yet they give the underlying super fund members the ability to switch those exposures with a click of a mouse. And
it's a story as old as finance itself, isn't it? Where you're mismatching assets and liabilities.
Yep. So look, this is a chart that shows the month-to-date performance for every stock in the portfolio that we've owned at some point in time during the month. Viva Energy up the top there, it looks really good, but that's only because we've only just added it to the portfolio and it hadn't fallen much at that point in time. You can see there's hardly a stock in this portfolio that has fallen less than the index. And as we go through some of the holdings that we've got here, we've got businesses that are largely unaffected by what's going on out there. We've got businesses that have got significant amounts of net cash. It hasn't really made a huge amount of difference. I had a bunch of questions leading into this about whether we should be owning a better quality portfolio than what we've got. I think we've actually made a lot of progress on that front over the past 6 months. We've got some better quality businesses in this portfolio. They haven't really performed any better than some of the other stuff that's in there. We've got businesses like car sales that are down 40% as of today. Smart Group, a business that, as I'll talk about in a moment, I think is a really high quality business with lots of cash on its balance sheet. It's been punished as well. So there hasn't been a huge amount of discrimination across the portfolio. And I think people should prepare themselves for significant potential further markdowns from here.
Again, getting back to the point you've made on previous roadshows, this is not an excuse, but it's a fact. If you put down the small ordinaries returns here, our distribution of this portfolio would be a lot more bell curvy, if that makes sense. Yeah.
And I'll just reiterate as I keep going through this as well, it doesn't really make a huge amount of difference to me whether some of these stocks trade down half, and I'll show some of the volume stuff coming up in a moment, but we're not sitting here assessing the value of our own companies on the basis of fairly small amounts of shares that are traded from one person to another. In fact, I think we're going to get some pretty significant opportunities over the coming weeks and months to take advantage of some of that forced selling as we adjust the portfolio.
Okay, well then
just talking, go on.
You go, mate.
I was just going to bring up something here on the liquidity side of things. I said in the note that I sent out on Friday, at one point there, we had a Nero group with a best bid in the market of $1 a share, and the offer was $1.30, and you had one trade of 700 shares that moved the share price down 25 or 26%. You're seeing that, that was a fairly extreme example, but you're seeing fairly small volumes of shares here move prices by significant amounts. And this is a table here showing the percentage of a company's shares outstanding that have been traded during the month. And you can see businesses there like Mainstream, for example, you've had 1.4% of the outstanding shares traded for a minus 40% return. In Nero there, its share price is halved. There's only 2.5% of that company's outstanding shares have traded. And, I use the anecdote here. You wouldn't sit there if someone was a forced seller of your house in your suburb and say, well, my house is now worth half of what it was because someone down the road had to sell their house at a massively discounted price. And I think we're seeing a lot of that across the portfolio, and it's not just our portfolio. I think you're seeing it fairly widespread out there in the small cap universe. And like I said, if we keep getting redemptions and we keep getting people forced to sell stocks, you might see a fair bit more of that.
Right, and maybe we can move on now to some of the particularly problematic stocks.
Yep. So I've tried to put up a chart here. It's not the most scientific chart in the world, but I just wanted to try and give people an insight into what we've been doing with the portfolio, trying to distinguish here between businesses where we think the revenue is under a significant amount of threat, and then on the other side of that, businesses where we think the balance sheet is a concern. So you can see along the bottom axis here, businesses where we think there's revenue resilience. So RPM, Global, and Smart Group are the two businesses in the portfolio that we think the revenue will hold up best through this. And we'll talk about a couple of stocks later. And up the top, if you go from the left-hand axis and you go up, they're the businesses that we think are best placed because of their balance sheet resilience or their business model to work through this crisis, even if their revenue is particularly badly impacted. So if you look at Matrix, for example, with the oil price where it is, that business's revenue is going to be very substantially down from where it otherwise would have been, but the business has got $20 million of cash on the balance sheet. A very good chance of being able to work through that. And Nero, the same marketing services company where the revenue is certain to be cut dramatically, but historically has shown that it's got a very flexible cost base in terms of being able to adjust its number of staff to deal with the amount of work that's out there, and $40 million of cash on that company's balance sheet. Some of that still owes for businesses that it's purchased in the past, but it's in a very strong position to navigate its way through this. The ones that we want to worry about are in the bottom left of this matrix. Put NZME up there as a business where the revenue is going to get hit and it's still got some net debt on the balance sheet. Eclipse is a car leasing business where I think the revenue probably holds up okay, but it is dependent on financial markets in terms of its ability to navigate this crisis. So it is more vulnerable. We've got a couple of very small positions in some travel stocks that you and I are going to talk about later in the presentation that are tiny, but so the size of the bubble here is the size of the position down in this bottom left corner. And I'd say the most vulnerable stock that we owned at the start of the month was MRM. It had a lot of debt and a lot of exposure to the oil markets as well. It's a stock that we've taken our medicine on and sold as of last week, so it's not in the portfolio anymore. And we're really concentrating on this rather than trying to stress about share prices and dramatic moves in the underlying prices of these stocks, trying to make sure that the portfolio is positioned here to survive out the other side of this, and then the share price can look after itself.
I mean, obviously, we need to look at the results. So we need to look at how business has been travelling and where it's going, I guess. There's been a pretty big external shock to the system here. I just thought maybe we could talk about a couple of the stocks that have perhaps particularly on people's mind in the Aussie fund here.
Yep.
So let's talk a bit about Thorn. Obviously, that's one where we've been somewhat activists over the last 12 months. It's going to be on people's minds. It's 12 million market cap now. People are saying it might be a naught from here. So how do you feel about its prospects from here?
Look, I think whenever you've had a share price retraction of this magnitude, you need to listen to the market to some extent and accept that things haven't been going as well as you would have liked. We were sitting there, I guess, a couple of months ago thinking we've made quite a bit of progress over the past 12 months for this business. It's got a completely new board. It's got a new CEO in there. The board are generally representatives of people who've got a lot of skin in the game. So we're far more confident that they're going to make the right decisions here. It's got two businesses, and it's really important from my perspective to distinguish between those two. It's got a small and medium business equipment finance business, which I expect will be very, very hard hit by what's going on out there. It's right in the center of the businesses that are going to struggle most to deal with this. And I would say that type of loan is one of the first things you cut if you're a small business. There's a lot of government initiative out there to try and protect that space, and hopefully Thorn are working very hard on trying to access some of that support, but I would not be surprised at all if that part of the business is worth zero. They've got about $40 or $50 million of equity tied up in that equipment financing business. We tried very hard to support the sale of that business last year, but weren't successful with some of the other large shareholders, but it is what it is, and it's probably a zero. But look, I think the really important thing here is the majority of this company's assets, more than 2/3, are in the radio rentals business. And for all of its troubles over the past few years, that business has historically been very resilient through downturns. I think a lot of the government support that's out there is going to be beneficial to it because a lot of its clients are low socioeconomic. So putting the amount of welfare that people are receiving up is going to be very helpful. And historically, higher unemployment has meant more people that need radio rental services. So to the extent that they can quarantine the losses on one side of the business here, and we've been meeting with them regularly and pushing hard for that, but as long as they don't let the losses on the equipment finance side of the business infect the other side of the business, I am very, very confident that the business will not only survive, but probably come out of this on the radio rental side in a better position than it was going into it.
And is that infection possibility like entirely within their own control now, or are there some cross guarantees or anything to worry about?
My understanding is it is. It's a warehouse
just be a
financing facility that's applied to that part of the business. So what happens there is every time there's a loan that is a certain amount of days overdue, if Thorn wants to keep putting assets into that facility, they need to take the assets out that are overdue. So that the risk here is that you keep doing that as this portfolio continues to deteriorate, rather than pulling the pin on it at some point in time.
Yeah, okay.
So look, I mean, we're a bit beaten, battered, and bruised by it. It feels to me like the market reaction here has been dramatically overdone, given you've got a significant percentage of the business that is fairly well placed. And that other side of the business is unlevered. There's no debt against the radio rentals business. There's cash sitting in the bank account at a corporate level that is more than the current market cap. So to the extent that they can navigate their way through it, there's a huge amount of upside.
Hey, can you hear me all right? I'm getting an unstable internet warning.
I can hear you fine.
Yeah, okay. And I guess the other thing to discuss here is the tourism exposure. We have some direct tourism exposure in the portfolio. Experience Co, it's running skydiving operations and reef tours, which is going to be hard hit. Apollo and Tourism Holdings that lease recreational vehicles, and we also have a small amount of Webjet. Any insights you have on that part? Obviously facing a pretty huge demand cliff.
Yeah, look, all three of those latter investments that you mentioned are new ones for us and tiny in terms of their positions in the portfolio. You know, range between 50 and 90 basis points, so 0.5% of the portfolio or 0.9% of the portfolio.
So to clarify, you're talking about Apollo Tourism and Webjet, yeah?
Correct. Tourism's a Kiwi company, which we recently announced that we've opened up the mandate on this fund to invest in Kiwi companies as well. So it's given us a little bit more of a universe there. Look, I think Webjet is in a trading hold at the moment for a capital raise. We've taken small positions in some of these businesses in anticipation of being able to participate in some of these capital raises. So we're waiting to see the details on that one. It might be an interesting opportunity, but obviously the revenue is going to zero in the short term. The other three of those businesses are asset heavy, and that's what I think is interesting about them and where I think the upside is. They're not businesses that have huge amounts of ongoing costs if they're not doing business. We had a conversation with Experience Co, for example, last week. They put out an announcement this morning. They're able to cut the costs in that business dramatically, and basically the strategy here is to mothball what they've got until conditions improve, hopefully later this year. But what you do have is, in Experience Co's situation, $100 million worth of tangible equipment there, and it's actually quite usable in other spaces. The types of planes that they use for skydiving, for example, are planes that you can use for other purposes. So our aim there is for those companies to bunker down, to pull down the shutters, to minimize the amount of costs over the next 6 months. And then when things start to return to normal, hopefully later in this year, but we're not dependent on that. I think they can survive longer than that. You'll be in a good situation with these businesses with lots of asset backing on the balance sheet.
So then bring assets back online and then liquidate some assets if you got surplus.
Correct. And it's going to be slow. Things are not going to return in a hurry.
Yeah, I presume nothing's trading at the same price you could have sold it 2 months ago, right? No,
absolutely. And look, you've got in Experience Co's case, you've got about 16 cents per share there of NTA. It's currently trading at 4, so you don't need to sell too many planes, or you can afford to take a big haircut is the other way of thinking about it, in order to create some liquidity in the short term, which gets you through to a better position here. Look, I think that total exposure in the portfolio, it needs to be managed carefully. There's actually some good businesses in there. They've historically earned very good returns on capital, and I think they go back to earning good returns on capital at some point in the future. But the environment and the amount of time that you're going to need to survive here is very unknowable at the moment, and we need to be careful in terms of our overall exposure to it. I just wanted to touch on a couple up the top here as well. Like I said earlier, it hasn't really made much difference whether the business is affected dramatically by this or not. We own 2 companies that are very exposed to the mining sector. The mining companies, their share prices have been holding up pretty well, but the services space has been absolutely smashed. Lots of small cap stocks in there. RPM Global is a business where we're really, really happy with the progress of it. It's a high quality software business. They're quite dominant in their spaces, and they provide software to mining companies to do all sorts of different things around the mine. It's got a very significant pile of net cash on the balance sheet. It's got net receivables as well, so you're not going to suffer any working capital outflow if it slows down there. And yeah, our understanding is that clients are still getting on with life and spending money in that mining space. So far, they've seen very little impact on the business, and they're sitting there saying, look, it's going to be a bit harder for us to sell new software, but the annuity subscription side of what we've got here, we don't see any reason why it should slow down. And the share price has halved over the past couple of weeks. It's another one of those ones that held up for a little while and then sold off quite significantly just in recent times. And Macmahon, the majority of this business is 4 or 5 long-term contracts here on low-cost mines. Obviously, you've got some risk on the fly-in, fly-out side of things. If they are flying workers into some of these mines that at some point they have to shut down because something goes wrong there. We know of nothing that's happened on that front yet. The share price has halved. We actually got a bit of money off the table with Macmahon when the market had sold off a lot, but it hadn't. We were able to realise some liquidity there. So we had sold a bit of it coming into this, but at today's prices, it looks particularly attractive for one of the few businesses in the portfolio that I look at and say, well, Aussie dollar dramatically lower, half of its revenues in US dollars. It should be pretty well placed to at least hold its own in this, if not grow its profitability a little bit.
Is the intention there to keep these mines all open? They think they can work around this problem, or do you think shutdown's inevitable at some stage?
No, I don't think so. I mean, they're fairly, you take its Batu Hijau mine
Quarantine.
up in Indonesia, it's on an island that's very quarantined from the rest of Indonesia. So I think to the extent that they can stop people coming in and out, and it's largely a local workforce. So, and the people who work for Macmahon up there live up there, so they're not flying people in and out of that mine. I think they're, it's a pretty important part of the Australian economy, and producing coal and commodities that we're going to need is pretty important as well. So my understanding is until they have an issue with someone potentially testing positive or something, they're going to play it as safe as they can and keep trying to work through this. And then the next down that list are 2 marketing services companies that we own, in Nero and WPP. Clearly, companies are going to slash their advertising budgets in this, and we're not pretending for a second that these 2 businesses are not going to be hit by it. Nero's got a very significant cash balance. It's very well placed to navigate this. Both of these businesses have historically showed when their revenue shrinks, the cost base, which is almost all staff, shrinks as well. So it's going to be an unpleasant period for both of them, but I don't see solvency issues there. WPP only just sold its stake in a business called Kantar. It got $150 million for that. It's paid its debt down to quite conservative levels. There have been a lot of companies slashing their already declared or retracting their already declared dividends over recent weeks. So I wouldn't be surprised if this one gets cut as well, but it's supposed to go ex a 4.4 cent fully franked dividend. It was 11% of the price on Friday. It's probably 12 or 13% of today's price that investors are going to get back as a fully franked dividend. Talked about Thorn and Experience. A couple of stocks here. I mentioned those auto leasing businesses and salary packaging companies. We've reinitiated a stake in Smart Group. We own some shares in this and we're disappointed with some of its recent results, but it's another business with net cash on the balance sheet. It's been a high quality business over a very long period of time. A lot of insider buying going on over there over the past couple of weeks, and yet the share price continues to fall. So that's a particularly attractive new addition to the portfolio. And we've owned Eclipse there for some time. I think the revenue line here will be quite resilient, but this is a business that has more leverage than I would like. It's dependent on funding markets, and they put out a presentation last week saying they don't need to access funding markets for another 2 years. But we saw through the financial crisis that these types of balance sheets can be problematic when you get in trouble. I think people are assuming, like we talked about earlier, that this is exactly the same as the financial crisis. I think you'll see funding markets do their job better this time around, but it's still a risk whenever you've got that much debt on the balance sheet. Again, the share price there was $1.70 on a pretty good result in February, and it's now trading at 40 cents. So it has been absolutely walloped. And to the extent that they can navigate through the next 6 to 12 months, there's no reason why it can't be worth that $1.70, or we thought it was worth significantly more, so even more than that. Okay, we might move on to the FISF discussion now, Gareth. I haven't put a performance slide in here. We had a few issues this morning trying to finalize that number. Well, we have a pretty good idea what it is, just trying to get approval from the administrators to make an estimate at our end before they've been able to confirm what it is. I would say that roughly the MSCI World Index in Australian dollars is off about 15% for the month. And my guesstimate at where the international fund is about 20%. There's 4% and a bit difference between those two months to date in that portfolio. Obviously, it was performing quite well up until Christmas. So if we look back over the financial year, they're probably roughly in line with each other. And this is a chart. You can see why that's the case when we compare this chart to what we've seen in the Australian fund. There's a lot more bars there on the right-hand side of the world index. Just a couple of things to point out. We own a bunch of, sorry, go on, you go.
No, you go. Fine.
We own a bunch of stocks that, well, look on this chart like they are largely unaffected. Yum China listed up in Asia, a couple of Hong Kong listed stocks there, and Sony, which is the 6758 JT, where the share prices have hardly budged through this meltdown. If you told me at the start of January that Yum China was going to be our best performing stock for the year, I would have laughed you out of town. It's been a shock how well that share price has held up. Obviously, the Chinese economy is in recovery mode and people are now getting excited about that. But the hit to the business was pretty significant during that first quarter of the year. And I think this assumption that the Chinese economy is going to sail on fine if the Western world goes into a dramatic recession is probably a bit optimistic from my perspective.
And I'm getting a bit spotty reception here. Can you hear me fine?
I can hear you, but you're coming through delayed at my end. I might just,
okay.
Let me just check my phone and see if anyone's sending me any messages. No,
It
all
could
good
be
by the
mine.
sounds of it.
It probably is mine.
Do you want to just drop out and dial in again?
It's important to note, I think it's, if you can hear me fine.
Yeah, it's slightly late. Just drop out and dial in. Sorry, folks, we'll just wait for Gareth to dial back in. Be 1 second. Maybe, might have lost him. You back?
Can you hear me?
Yep, got you now.
Okay, look, the point I just wanted to make before was with this sell-off globally has been, you know, pretty much as extreme as what we've seen in Australia. We've been substantially cushioned by the impact of the Aussie dollar depreciation. So when we report -15, our results in US dollar terms, or basically any other currency, has been, you know, it's been a more extreme shock to the system. The actual share prices are down sort of as much as what we're seeing in Oz. But the currency is giving us some cushioning. And again, here we have a small and mid cap focus, I would say, in this fund, but it's not as micro cap focused as the Australian fund. So generally a better quality, better mix of higher quality businesses and bigger businesses that probably weren't as cheap to begin with. There's just some strange things happening in this market. I've been talking with Steve about the effect on Vienna Airport, which is obviously directly impacted here and may end up experiencing something close to 100% fall in revenue for a few months. We've seen Vienna come off, the equity come off about 50% from top to bottom. So it's gone from in the mid 30s, it got to 17 euros last week. Sydney Airport's done something similar in terms of its equity. It's approximately half, but Sydney Airport has a lot of debt. So in enterprise value terms, Sydney Airport's not down anywhere near in half. Vienna actually has effectively almost no debt. So the enterprise value has literally collapsed in half. And it's gotten to the point where I look at Sydney Airport last week trading on what's called an enterprise value to earnings before interest, tax, depreciation and amortization ratio. So this is an attempt to value a company absent how it's funded. And Sydney's gotten down to about a 17 multiple EV to EBITDA. Vienna was trading below 4 last week. Stocks up, now rallied about 50% from the lows last week. So just some really weird things happening in the portfolio and in the wider market.
Yeah. And there's been quite a bit of action across this portfolio. I guess if you compared the portfolio now to what it was 2 months ago, there's been quite a bit of change. Just want to talk through some of the transactions and changes that we've made?
Yeah, look, so we've underperformed the market, and the last week in particular has been quite hard there. And generally, there's a lot of small caps and quite a few illiquid names in there versus the broader big indexes that we follow. We've also been lucky in some sense. So when this meltdown happened, it just didn't happen widely across the board. So some sectors just collapsed and others held up reasonably well. So one thing...
Sorry, hang on a second. Hang on. Sorry, you just got a really bad line there. That's better. Go again.
Okay, so the market started the sell-off, and it wasn't across the board. So we had stocks like Blanco that held up really well. So we've sold more than half our position in Blanco as at 31 December. We've more than halved it, and most of that selling was done in the last 2 or 3 weeks at prices north of £2. And then in the last week, we've seen a lot of those stocks that held up well come and join the misery party. So yeah, it hadn't been indiscriminate until fairly recently, and we've tried to take advantage of that, and that's given us quite some buffering around the fact that we have a fairly small cap portfolio on the whole.
Yeah, we were both a bit surprised that it held up as long as it did in that case, and there was significant volume being bid all of the time as well. So it's still one we think will do very well long term. So we might regret those sales a few years down the track, but it's looking handy at the moment. Look,
it's about selling cheap to buy cheaper at the moment. So we've added to some positions here. We bought some Flughafen Wien, so that's Vienna Airport, not right down near the bottom, but pretty close. We added to our position in Ulta Beauty, which has been hammered because they're going to have to close stores in the North America in particular. And we've added a few new larger positions generally. So Uber in the last few days, Keysight, VTech. I mean, all up, I think the results we've had here has been more balanced, more what you would expect on the bell curve. Like that line runs roughly down the middle of all our different stocks in our portfolio. So it's been the sort of what we would expect now. It was strange that it wasn't happening all at once.
Yeah. And look, to be clear, it's not necessarily a good thing. I mean, extreme mispricings are a good thing from our perspective. And I think out the other side of this, you've seen this portfolio hold up much better than the Australian portfolio, and it's probably not as cheap. It's a very attractive portfolio of businesses, and we'll talk about this in a second. I've got the same sort of slide here. We've got the vast majority of this portfolio invested in businesses that we think are fairly resilient, that are likely to not only make it through this crisis, but probably not have their revenue hit too hard in terms of the larger weightings up here. You had a call with the Blanco management team last week, Gareth, and they seemed pretty optimistic about business and their ability to still hit their guidance for the year.
Yeah, I mean, that's partly impacted by the fact we're 3/4 of the way through the year, and there's no doubt this is going to impact the sales effort for this business, and that's a really important part of the growth. But I don't think that business goes away forever. I just think it's a fairly temporary issue. We also do have perhaps more concern ourselves about the volume impacts here on the existing customers. But again, this is a well-financed business, and we think it's got the wherewithal to survive really tough times.
Yeah, I'd say the one business we're most worried about here in terms of survivability would be SkyWest, which is a regional airline in the US. Its share price has been pummeled accordingly. It is undoubtedly the strongest player in that space of regional airlines in the US. So there's every chance that it comes out of this much, much stronger than it went in. There's already been a couple of competitors say that they're going out of business. But I think that whole airline industry is one that is under a huge, huge amount of pressure, and SkyWest is not going to be any different. I think you're going to see, they've still been operating at reasonable capacity in terms of domestic airlines over there in the US, but that is going to get shut down very, very quickly, and you're going to have a business that has very little in the way of revenue. It's got a lot of locked-in contracts with the large airlines in the US, but obviously there's plenty of desire to be pushing those out or trying to renegotiate them. So that's the one in the bottom left-hand corner. Like you already touched on, even Vienna Airport, yes, revenue is going to get hit very, very hard by what's happening out there, but it's probably the strongest balance sheet of any infrastructure stock in the world. In fact, it's been something that we've been whinging about to the management team there, that they don't have enough leverage. So they're probably nodding their heads.
Just to put it into perspective, they have net debt close enough to zero, but it's actually 300 million and a little bit of change, a loan from the EIB, and then they've got 200 plus million of cash and marketable securities. And so I think you can shut down and have zero revenue come in, and you can cover your cash costs for look, at least 6 months here, probably more like 8, literally based on the cash on the balance sheet. You don't even have to make a call to your lenders. You don't have to make a call to shareholders. So that's a nice position to be in this sort of, it's serendipitous, let's say.
And Alta is actually in the same position. I mean, it's not a good situation, obviously, when you've shut down all of your stores, but they do have an online business, which I expect will pick up a chunk of that, and a very, very strong balance sheet to help it navigate this environment. So yeah, it is a portfolio here of stocks that, for the most part, are well placed to navigate what's going to be a very difficult environment. Do you want to just touch on a couple of the key holdings here, Gareth, and any conversations we've had around them or how they're placed?
Yeah, sure. We talked about Blanco a bit already. How about you talk about Zebra? Are you a bit better placed on that one?
Yeah, so this is it's now the largest holding in the fund. The Aussie dollar depreciation here has had us sort of rushing around trying to rebalance some of these things that are listed in US dollars. Their weighting has gone up quite substantially just because the Aussie dollar and other currencies have fallen a lot. So it's now surpassed Blanco as the largest holding in the fund. Key clients here are in logistics and retailing, and those services are obviously in demand. So we're not expecting a huge hit on the revenue side of things here. Price has held up accordingly, I would say. It's got a very strong balance sheet and good cash flow in this business. So, it's one that we're very comfortable with in the portfolio, but also one where the share price hasn't retracted as much. Blanco, we already talked about. I mean, Alphabet, I think this business is probably the first cycle where their market share growth is going to be offset by the general economic conditions. They've got a lot of advertising revenue, and particularly from the travel industry. They've basically taken the whole pie, I would say, in online travel is accruing to Alphabet at the moment, and that's going to be hit pretty hard. So you can expect that business to get hit, but it's I just crunched the numbers for this presentation, but it's $115 billion of net cash sitting on the balance sheet. So that's an extraordinary amount of money. It's more than Australia's whole stimulus program that they've announced so far. Spotify, again, held up very well because that business shouldn't be too hard hit. And Yum China, things getting back to business in China, and therefore that share price has held up very well.
We've already touched on Flukabin and Alta. Again, just they're businesses that are clearly impacted, but I think the message here is that we believe they have the balance sheet capacity to get through this and come out the other side, and stock prices have just been hammered. So we've been taking advantage of both of those where we can. And then we've got a few new additions. We have bought Uber in the last few days. So maybe you want to touch on that one, Steve. A lot of capital, I understand. Obviously, the business is getting hammered, as you would expect.
So we've been following this company for a while. It was marked down as a missed opportunity. We looked at it at sort of $26 or $27, and there was a lot of pessimism, a lot of shares that just come out of escrow that have been sold off. And we had a good look and couldn't quite get comfortable. And then the share price subsequently rallied to 40 and 45. And recently it was down as low as $15 again. But I think ultimately this is a high quality business. It's had its troubles. I'm in the middle of reading a book about Travis Kalanick, actually, the guy who founded it. And it's been a very interesting story, to say the least. But this is a business that is all about network effects. The more cars you've got, the more clients you've got, the better service you offer, the more people are going to keep using you. And in a lot of countries around the world, they're well past the cash flow break even. And in fact, in that rides business, it was quite profitable last year as a whole, even though some of its jurisdictions were still losing lots of money. What's been bleeding for them has been the food delivery side of things. That's obviously doing well through this type of market. And I think you're going to see substantial consolidation there. There's a lot of businesses burning huge amounts of cash there that I think this environment is likely to bring to an end. So
there's a concept that you want to own the strong hands, because in these difficult times, that's when they can really get an edge over the competition. And I think, Uber on the rideshare side is probably well placed to do some of that, but particularly on the food delivery side, right?
Yeah, absolutely right. Absolutely.
Mate, just
right.
before we
you've
move
had a
on,
new management team. Sorry, go on.
So we just got a slight technical hitch and I can't see all the Q&As that have been banking up. Can you still see down the bottom of your screen?
I've got
Like
43.
Right, so don't get logged out because once I logged out, it kind of disappeared. So you're going to have to manage that, I'm afraid.
Okay, no problems.
Sorry, Keysight.
Yeah, I'll just touch on it quickly. We'll write about it more in a coming report, but again, it's another business that Harvey in particular has had his eye on for a very long period of time. It's a globally dominant business in electronics testing space. So when you think about telco networks, electricity networks, people walking around with devices to check equipment, to check new inventions, to check that things work the way they're supposed to work, a whole heap of new work for them in the 5G space as new devices are rolled out and new networks are rolled out. It's been a great business. It was a spin-off that's been performing very well now for 5 or 6 years since it was spun off, and great management team, good capital allocation, lots of things to like. Again, some of our Aussie stuff's trading at 2 and 3 times earnings. This is a high quality business trading at a multiple that we think is cheap for its quality rather than something that's at those low sorts of numbers. It's a 15, 16 multiple for a business we expect to grow at 10% or more for the foreseeable future.
Okay, and you wanted to make some specific points about Asian stocks having held up quite well.
Yeah, I mean, you'll probably see us, and this is true again across both portfolios. I think there's lots of opportunities for rebalancing, but some of that stuff that's held up exceptionally well there. Look, I think there's an argument to be made that Asian markets were much cheaper than other markets around the world to start with. There was more pessimism about that part of the world, but the fact that some of those stocks have held up as well as they have, we've been looking for opportunities to replace them. I do think, we've had a lot of questions about, well, why isn't the Australian fund like the international fund? I think partly that is a function of history, but mostly it's a function of the opportunity set that's in front of us. One of the benefits that we have with this international portfolio is we have a huge spread of businesses in different industries, different geographic jurisdictions, and different growth versus value. There's just so much choice out there. And I really like having a portfolio that is resilient to a range of different outcomes, and having some of that Asian listed stuff in there has helped us a lot through this period. And, I don't think we completely want to lose that.
I think maybe we can close up soon on this and get into the Q&A, but I think one of the points here now is that we have some substantial opportunities to switch investments in the months and even years ahead. I mean, in the bounce out of the GFC, I'd say that was probably 3 good years where you could bootstrap in a higher quality or into cheaper stocks, and there were opportunities there. Some things moved, other things didn't. And I think this gives us perhaps a bigger platform to work with in terms of doing stuff like that may last for a couple of years. Yeah.
And look, I think that applies to both funds. And I think on the Aussie fund side of things, we've been coming in for a lot of probably justified criticism. It's been a few years of bad performance there. We went into this with a portfolio that we thought was very cheap, and it's halved over the course of the past 6 weeks or so. I think that if we get a year or 18 months down the track and we haven't performed outstandingly well out of an environment like this where good ideas are abundant, then it's time then to sit down and assess that and ask some very serious questions about the job that we've done with that fund and how it's gone wrong and what the future for the fund needs to be. I just don't think that now is the time for doing that. I wasn't sitting there in the financial crisis when RHG fell from 40 cents to 4 cents saying, I've lost 90% of my wealth. I was looking at it and saying, this is an extraordinary opportunity for me to be buying something very, very cheaply. And I think, I'm not guaranteeing anyone that any RHGs come out of this, but I think it is an environment where people are just selling anything that they can sell, and that creates extraordinary opportunities. And our focus as a team and as a business is on making the most of those opportunities. And my advice to everyone else is to try and, as much as possible, close their eyes to the daily gyrations in the NAV. And again, this is true across both funds. We may go through a period of a lot more volatility in that international fund that we've had. We may well end up invested in less liquid companies at the end of this if we start finding extraordinary opportunities. So people need to be focused on the businesses that we own and the investment cases for those businesses and what we think they might be worth out the other end of this crisis, rather than getting too worked up about any day-to-day movements.
Here comes my Harley Davidson driving neighbour. Got to run up the driveway. Look, maybe we should move on to Q&A now, if that suits you, Steve.
Sure.
Look, we've got a ton of questions. We're going to hang around as long as we can to answer as many as we can. We're going to try to get through just about everything. We've got a lot of duplicate questions, so please recognise that if we won't be answering the same question in 5 different ways, but we will endeavour to get around to everything. And we're going to get back to anyone that we've missed here via email. Thanks for everyone that sent in questions. If you don't feel we've adequately addressed anything in this particular webcast, then please do get back to us. We're available for calls. We're available for emails. I've had a little glitch here, so I can only see about 10 questions, Steve. So I'm going to get the ball rolling on those. You're going to have to manage the rest.
Well, how about I give you a couple, because I've got a couple here from the start that are up your alley.
Okay.
Sylvain wants to know if you're finding any cereal stock yet. And she also asked if you're eating your hat on Roosevelt.
Yeah.
You'd eat
so I read that
apparently
before,
you said
so
you'd eat your hat if the company was not larger in 10 years.
I don't know if it's my selective memory, but I did say that about ARB back in the day. It's an intelligent investor. It sounds like the kind of thing I could have said, but I can't remember actually saying it about Rosenbauer. But that said, it's a business that's been growing its sales, at least on what we've expected. So the business is getting bigger. Where this investment thesis has not gone to plan is on the margin and on the working capital. So it's become a thinner margin business particularly as they've globalized, and particularly as some of their core markets have gotten really, really competitive. So Germany being a classic example, and which they are a participant in and partly responsible for. But the margins have gotten thinner and the working capital's blown out as well. So it's taking longer to earn the margin off each bit. So they've got a lot of plans there. The rubber hasn't hit the road yet. So I'm not quite prepared to eat my hat yet. I'm not even sure I made that promise, but we'll have a look at that in a couple of years' time. We do still own the stock. We sold a little bit just going into the crisis there around 35, but it's obviously been hammered since. And then the other question was, what was that again? Are
you finding any cereal stocks yet?
Yeah, I'm on the lookout. There's some that are getting close. I'm happy to talk about. I fired some bullets into the fund over the last 2 weeks, particularly in last week. So I had some cash sitting on the sideline, and I've increased my unit count by more than 50% in the last week and a bit. So you can view that as a positive sign from me. Yeah, I don't need to eat cereal so far, but once I've fired all those bullets, we'll see.
Carl says, how much of the portfolios do you anticipate contain companies which will end up being worth nothing as they go bankrupt? Hopefully I've addressed that as we've gone through. I think the main candidate in the Australian fund was MRM that's been sold. There's a couple of others there that are obviously going to go through very difficult periods. And on the international fund side of things, SkyWest is clearly a business that's going to go through a huge amount of trouble as well. I do think that people, I've been spending a bit of time and getting very interested with some of the Australian listed retailers. And I think this concept that, okay, you've got a whole heap of lease liabilities over the next 6 months. You may have a working capital unwind and therefore you're going to go broke. I think there's a lot of steps in between that. And it doesn't make sense to me that a Westfield is going to turn around and say to every single retailer who is a tenant of its that you're gone and we're putting you out of business, because when the traffic comes back, they're not going to have anyone in the space. And I think the retailers that have historically done well and attracted traffic to those shopping centres, I find it hard to imagine that the landlords of those shopping centres are not going to turn around and say, we can make something work here. And I think that's where
probably even more so than usual now, because the pipeline of new concepts and whatever is going to be hammered for a few years probably.
Yeah,
people
and I think that's where the cheap
start a small business.
That's where the central banks and the funding comes into this as well. Let's say you are the property trust and you're sitting there saying, well, if we defer all of this rent, what's it going to cost us? And your cost of debt is only 2 or 2.5%, then 6 months worth of capitalisation there. You're adding a percent or two to the outstanding balance of what that retailer owes you, and you can probably fix that up down the track somehow. So I think this is different from this business has taken on too much leverage, or they've completely stuffed something up, or the concept is old and it's dated and it's going out of fashion. This is an exogenous shock to the business. And I think you're going to see a fair bit of flexibility in the system in terms of people saying this is a viable business 12 months, 18 months down the track, and there's absolutely no sense in us sending it under. So we don't actually have, Alta in the international fund, obviously, but we don't have a lot of that direct discretionary retail exposure, but their businesses, you look at a Lavisa's down 80 or 85% or whatever it is over the past month or so. And I look at those, what has historically been a very high quality retailing business. And I think it's an area for people to be looking at opportunities. So I don't want to say there's nothing in our portfolio that's going to go bust. And I actually wouldn't say that we wouldn't invest in something in a very small way where the risk was there, but where we think the upside is very significant as well.
And probably the other thing to add here is, the concept of a V-shaped recovery versus a U, or whatever the hell you want to call it. We have a problem here where the demand's fallen off a cliff very, very short term. If we can rebound out of this strongly, then, the world can sort of go back to something resembling normal. But this could trigger, financial implications for companies if it drags on too long. And
yeah,
I think,
it almost will, right? Like it's a fait accompli. I think that is.
Yeah, but the magnitude and the duration is sort of more of my point.
That's why I think, and maybe this is from an economic perspective more than a health perspective, but I just do not understand the flattening of the curve concept that we're going to drag this out for 8 or 12 months here, because the businesses are already laying people off and they're struggling, and I think the concept of crushing it here, like they have in a lot of Asian countries, makes a lot more sense to me than dragging it out.
Yeah.
Jock says, do you measure intrinsic value of the total investments, and is this something you would report? We do measure it, and I don't think anyone will believe me if I put up some of the intrinsic values that I think some of our Australian fund stocks are worth at the moment. So it's not something that we're going to run around and make a big song and dance about, because it's only something to get hung by down the track. But look, obviously, I'd say intrinsic values have come down across the board for the most part. The question is, what's the magnitude here for how much you should be adjusting things by? Are you going to lose 1 year's profitability? Is the business going to go bust? Or somewhere in between those two things? Because I think if we're going to lose a year's profitability and then it's going to take a year to recover, it doesn't really justify 50, 60 and 70% market price retractions. And I'd say most of the stuff that we own here is either unaffected or is something that we think can navigate through it and get back to historical levels of profitability pretty quickly.
And I've got a question here from Matthew. I'm sure it's on a lot of people's minds. What do you think of the big four banks at the moment? He's listed the prices. Obviously, they're down substantially. Is it time to buy?
Ooh, that's a good question. I think they will be fine. There's a controversial answer for you. I think it's going to be very hard. Our experience overseas, even with really high quality banks like Lloyd's, has been that in a close to zero interest rate environment, it is very hard for banks to earn a healthy net interest margin, because they used to have a significant percentage of their deposits that were paying zero interest, and they would lend that money out at 4 or 5 and collect very healthy margins. When the lending rate comes down to 1.5 or 2, the deposit rate can't go below 0. So it tends to squeeze margins, and you are going to see that in the Australian banking sector. I don't think you're going to see huge amounts of financial distress here, at least if this is a 6 to 12 month recovery here, because I think you're going to see everyone just push the repayment of things down the track, from mortgage holders through to businesses through to everyone else. You've got a lot of government support here and a lot of government guarantees for the banks to keep lending money. So I'm not worried about them from a solvency perspective. Like I said, from the financial crisis, there's a lot more capital, more so in the overseas banks than in the Australian banks, to be honest with you, but there's still a lot of capital in the Australian banks as well. I think the risk here is that this all flows through to dramatic falls in house prices. That would be the complete catastrophe for the Australian economy. But I think with the cheap money being pumped into the system as hard as it is, that's probably not super likely. What are your thoughts on that, Gareth? You're probably a bit more pessimistic than me.
Yeah, but every time I make a call on house prices, that it gets proven wrong. So I'll just stay away from it. But I think that we need to recognise that we have an unusually high amount of risk here in balance sheets in Australia, just in terms of debt. It's a massive debt load by historical standards. It's all fine with interest rates down at near nothing. But it could be a problem at some point. And when you have a crisis like this, that's the logical time for things like this to boil to the front of people's thought processes. Norm asks, will the ASX shut down? I don't know if you've got an opinion on that one, Steve.
I doubt it.
I hope not. I think it would be a mistake. And usually, we have these triggers that stop trading for a little while, and maybe there's some sense to that. I think a longer term, and even during September 11, it was 3 days that the market was shut, something like that. Yeah, I don't know. I mean, you shut down the market and people are going to liquidate their bond portfolio instead. There's often significant knock-on effects. I'm not sure it's a wise decision, but I wouldn't rule it out.
Yeah, and I just think, who are you trying to protect there? I think you do things like that if you think the whole financial system is going to come crashing down, and I'm not seeing signs of that yet, but because you've got someone liquidating a fund because they went into this with the wrong sort of structure, or their clients are panicking, yeah. I'm not sure that we need to be shutting the stock exchange to protect them.
Mate, that doesn't mean the central banker won't disagree with you, right? It's
correct. Yep.
I agree with you.
Comments on Flight Centre and Webjet. I guess we have a tiny position in Webjet currently going through this recapitalisation. We'll take a good look at the details of that before committing any money to it. Again, the share price retraction has been dramatic, but these businesses face a very uncertain future, and for an uncertain amount of time is probably the difficulty here. I can see the rest of the economy getting back on its feet well before the travel industry potentially. There are scenarios, there's a huge amount of incentive out there to try and fix this problem, and that will be true of travel as well. So, testing is getting cheaper and it's getting faster, and I don't see any reason why at some point down the track you couldn't test every single person who arrives at the airport and not let them through until you get the result back to say that they're clear. If we can eradicate it from this country to start with, there's lots of medical work going on out there to try and solve the problem. So I don't think it's out of the question that 5 or 6 months down the track, you turn around and say, well, that's a problem that's been fixed. But I think if you're going to own those businesses, you need to prepare for a long and drawn out potential scenario here. And they're both probably going to need capital.
Yeah, I made a point the other day that the Flight Centre, I'm talking about Flight Centre, I'm not exactly sure on Webjet, but I keep a little bit of an eye on Flight Centre, even though it's outside my universe nowadays. But it apparently has cash on the balance sheet, but once you start worrying about the customer liabilities on the other side, the cash a lot of the cash ends up evaporating. Sorry, Flight Centre is a debt position now, but the debt position is worse than it looks if you go into this environment where you're selling no travel, because a lot of that balance sheet firepower evaporates.
I think it's something to look at for a lot of these companies. As I said earlier, I think you'll see a lot of landlords waive rent obligations, but you're going to be less likely that your suppliers are not going to want their money back from you. So these working capital unwinds, your revenue goes to zero and you still need to pay all the bills. We looked at a lot of these companies and said, oh, wow, it's a negative working capital business. Isn't that great? As it grows,
great when it
you
grows.
don't need to fund it.
Well, here in this case, it's often customer liabilities rather than suppliers, right? So you've prepaid a flight or whatever, and then you take the service down the track and the money sits on Flight's balance sheet for a little while. But they have started taking hard action. They talked about 100 store closures. I think that was probably 2 weeks ago. There was another announcement that Screw sent out the other day. So, I think it's one on the watch list for the Aussie fund, right? Be fair to say?
Correct.
An anonymous attendee has asked, how do we approach companies with high quality assets but the need to refinance debt this year? Sydney Airport and Ale Property come to mind, but I'm sure you can think of others. My answer to that is it's probably a surprisingly dangerous, shouldn't be a surprise to anyone. It's a dangerous area to play in, and we need to make sure we're getting compensated for with extreme cheapness on the equity side. And Sydney Airport, for example, doesn't tick those boxes for me yet.
That is correct. And I would go in anticipating that you're probably going to have to commit more capital.
Yeah.
So, Sydney Airport could do a rights issue tomorrow. Its market cap is still well and truly high enough to fund any of its upcoming obligations. So that business is probably, in hindsight, people are going to look back and say too much leverage anyway. So at some point you might see a capital raising down the track. So if you're going to invest in some of these things, I'd anticipate that you're going to have to put more money in. And I'd also try and work out who owns the debt, because I think the banks will be friendly through this whole scenario. They're under a lot of moral pressure as well as in their financial interests. If you've got a bunch of bonds outstanding that are owned by a hedge fund that would quite like to own the equity of the entity that you're invested in, then you might be in a very different scenario going into one of these downturns where you breach covenants and they just want to take the equity off you.
Yeah.
Umesh says if there's a lockdown for 2 months, it should kill GDP by 20%, 1.6 plus some more. Should there be a depression-like scenario? But I think that's exactly what is going to happen here. We're going into a shutdown and GDP is going to get walloped in the short term. I think the government's doing the right thing, though. I think the scenario here is everyone's obligations get pushed out into the future. The government funds people enough so that they can eat and put a roof over their heads. And then on the other side of this, you've got a lot more government debt, but the Australian government has the capacity to do that. It's relatively well placed compared to other people around the world. So I can envisage a world here where that 20% of GDP goes straight onto the government debt side of the ledger. We might come out of this with 100% debt to GDP ratio, which is still at the low end of some other Western economies, but much higher than we've seen in the past. But that is going to be the price that we pay for getting through this crisis. And the experience overseas has been, you'd be surprised how well things recover after this. And I think this is an equivalent event to a world war in terms of the magnitude of the stimulus that is going on out there. And it has potential long-term consequences. I think we've been stuck in this deflationary or lack of inflation environment for a very long period of time, similar to where the world was post the Great Depression, since the financial crisis. There's lots of arguments that is still here to stay, but I think you might also come out, a global stimulus here on a very significant scale might create some outcomes 3 or 4 years down the track that we didn't anticipate. So you might want to think about potentially higher interest rates down the track as well. Not that it's something I would bet my life on, that's for sure. Yep.
A question here from Clive. Hi, Clive. He gets the network effects with Facebook and our real estate group, which make it difficult for a customer to switch from one service provider to another. He doesn't see those network effects with something like Uber. So when Didi arrived in Brisbane, offering better deals, it took Clive 2 minutes to switch from Uber to Didi. And indeed, the Uber driver told him he should sign up with Didi because they would get a better deal. Uber doesn't own the vehicle, doesn't own the driver, doesn't really own the customer. It's probably an insightful question. Any answers for that?
Yeah, it's a good question. I think the network effects here are more powerful than most people appreciate. I've seen lots of competitors come into the Australian market and have a crack at it, and lots of people use it a couple of times and then just go back to the one that's got the most cars and turns up most regularly, and a couple of bad experiences with those things. I think you're likely to see less cash thrown at these markets than you have seen historically coming out of this crisis, and less people willing to fund losses for extensive periods of time. But it's always going to be possible that competitors come along. You look at that US experience though, where you've got one player with 70% of the market and one player with 30, and the one with 70 is making lots of money and the one with 30 is losing a fortune, lift over there in the US. So I think you can afford for people to come in and chip away at market share as long as they don't end up in the number one position, and you'll still have a very profitable business. I have seen them around a lot though, Didi, here in the Australian market.
I think potentially also as time goes on, they can proactively reduce their cut. If they choose to become the dominant player, they can potentially take a lower cut of each ride and establish their position. You agree with that?
Correct. Yeah, I still think the customer side of things are, yes, you can get people to use it. I think it's harder than people anticipate to get people to permanently change their habits. And this business has been growing very well in markets, even where the competition is there and strong. But I wouldn't write it off like it sits there as a permanent risk.
We've got a few questions here around the cash balances in both funds. And so I'll read you a representative question, this one from Yong Yi. Can you please comment on the cash levels across the two funds over the past several weeks and clarify if cash was deployed too early? And did you catch a falling knife, or did you retain enough bullets in the gun to put to good use?
Did we spend the cash too early? There's absolutely no doubt about that. And that's probably true over the past 12 months, more so than the past week. Probably me more to blame than you, that's for sure, Gareth. You're one for holding more cash rather than less. But, you know, I've had this view that it's our job to invest people's money in equity markets over a long period of time, not to sit here on huge piles of cash. We had a good run for probably 7 years of selling shares, holding cash, markets falling and being able to deploy it. And I would say I was guilty of not being patient enough in hindsight over the past 12 months. I think as the market has melted down, I would have put that money to work anyway. You know, I thought things were pretty attractive a week ago. You and I have both been finding lots of interesting things to do, and we would have been investing most of that money in any case. Like, I had no anticipation that it was going to be as deep and as long as it has been. And look, I still feel like we've got lots of capacity to do things that are really attractive in both funds. You know, we've taken our medicine on MRM, and that's realised some cash. We've got Viva Energy and car sales in that Australian portfolio. We've been taking some WPP off the table over recent weeks. Like, there is capacity there for us to sell something that's cheap in order to buy something that is screamingly cheap. So you can expect to see changes already in the portfolio and more so over the coming weeks and months. And that's even more true in the international fund, where we've got stuff that's held up very well. We've got stuff that is very liquid, and we're able to take that money and reinvest it very quickly.
Yep. Okay, a couple of follow-ups there. What is the current cash position of each portfolio? It's about 3 or 4 in the international last time.
Yeah, and it'd be 5 in the Aussie fund.
Yep. And just wondering what your thoughts are on deploying cash in the current market environment. Would you slowly add, this is from an individual point of view, would you slowly add funds or increase exposure now after dramatic falls recently? Thanks. Look, I think it's really important here to clarify that we cannot provide individual financial advice. And, you know, you need to, if this is something you need help with, you need to seek a qualified financial advisor around this matter. I can give you my example, which I sort of touched on earlier. I have some cash reserves. I have some set aside to buy a house. Hopefully get the opportunity to do that one day. And then I have some set aside for stocks. I've fired about half that cash waiting in the last 10 days. So that's my position. I'm quite happy if it falls another 30 to say that I missed out on an even better opportunity. I'll then take what I can with what I've got left. There was a blog post that Jeremy Grantham wrote in the middle of the GFC. I think it was called Reinvesting While Terrified, which I found quite useful over the years, and I've often thought of. He had bucketed his cash reserves. He'd held some cash coming into the GFC, and then just said he bucketed it and into fairly big buckets too, not drip feeding. That sort of works very well for me, but people will have to make up their own mind.
Yeah, it's one of the challenges we have in terms of cash weighting is that I've got clients that militantly don't want to pay me fees for sitting on a pile of cash, that they want to run that part of their portfolio themselves and let us do the investing in the market and flex as they go along. And other people that just want me to do the whole thing for them and hold the amount of cash that I think is appropriate. You know, rightly or wrongly, I've made the decision that I want to be mostly invested most of the time and let the clients worry about that. As a general rule, you want to buy low and sell high. So you need to force yourself emotionally, I think, going through these types of environments. This is not necessarily with us, I'm talking about anywhere, that you want to add to your investments when people are most fearful, and you want to take them off the table when people are most greedy.
Yep.
Quick question here about Experience Co. How long can they continue to operate without customers before they need to raise additional capital? They weren't as clear as we would have liked them to have been in today's announcement about that when we had a conversation with them last week. That number's at least 6 months and more like 12 if they see that the environment is going to continue for a longer period of time. We've been told the cost base is already down to 2 million a month there and can be cut further to 1 million a month with more work. A bit of advice on the Batu Hijau copper mines, and the current Indonesian owners will not think to walk twice about walking away, given the low copper price. It need to fall a lot further than where it is at the moment. That is a super low cost mine for those operators up there, and McMahon has been getting a lot of efficiencies, so not out of the question, but I'll be surprised. And they do own 40% of McMahon as well, so they're pretty closely aligned in terms of maximising the value of that business.
I've got a question here from Tung, who's asked, given the scale of the sell-off, is there a case to move away from small stocks to larger quality stocks with strong balance sheets and more liquidity, particularly in the Australian fund? You want to go on that first? Sure.
I'm actually feeling valid criticism of us for sure 12 months ago. I think you generally want to be in that part of the market when things are falling rather than when they're at their bottom. And my view is that what we've seen in the small cap and illiquid end of the market at the moment is where the dramatic opportunities for multiples of your money coming out the other side exist. And I think you can put a whole portfolio of those things together at the moment. I've always encouraged our client base as well. Hopefully, of our clients have a portfolio of blue chip stocks or an index fund, and we are a relatively small part of that portfolio. And our job is to get out there and find smaller, interesting opportunities that are giving your portfolio something that you're not getting elsewhere. Over the past few years, that has been something that's been bad for your portfolio. But the point is that we either need to do that job well, or we need to not be in the job, rather than us getting paid big fees for buying big blue chip stocks that you can do very easily yourself for next to no fees.
Peter asks, have you thought about protecting the Aussie portfolio by either buying BBOZ or a bear ETF? I think we're talking here about hedging or buying insurance. Any comments there?
Yeah.
I mean, the cost of insurance is, if you look on through the options market, for example, you could buy cheap options 2 months ago, even 1 month ago. Harry hindsight says we maybe should have, even though it's a bit difficult with the way our fund's structured. But the idea of insuring, the price of that insurance has absolutely skyrocketed for perfectly rational reasons.
Yeah. I think we've got another question there earlier as well about whether we'd hedge more of the Aussie dollar exposure. Hedge more of the international fund back to Aussie dollars, so that if markets rebound quickly, but the Aussie dollar rebounds as well, we capture those gains rather than them getting lost in currency appreciation. And it's something that we have actively talked about over the past couple of weeks. It's something that we've talked to the RE about. It's not something that I feel completely comfortable with, because I feel like we've sold a product to people here, and that product is unhedged, and our clients can work out, because we do that, what percentage of their portfolio they want to be exposed to foreign currencies and what percent they want to be Aussie, and it fits in there and does its job. And it has done its job being unhedged over the past few months. Again, other clients would rather us make some of those decisions for them. I'm probably in the camp that there's a lot of benefits to having that unhedged exposure in your portfolio. It may get unwound as things recover, but if you sit there and think, well, in that environment where everything is recovering and the Aussie dollar's going up, I'm probably doing pretty well anyway, and my Aussie portfolio is doing well as well. I just it's a question here around what the product is, and it's a long only equities product, and we want to be pretty simple and invest in equities rather than confusing that by doing things that if people want to buy protection, they can buy that protection themselves and structure their portfolio accordingly. Had a bunch of questions about retailers Afterpay, which ones we'd be most interested in. I've got Afterpay on my list for when we get off this call, actually have a look at. There's a lot of cash in the bank there. there's a lot of bears about that stock, particularly in the value investing community. I'm probably more optimistic about it than they are. I think it's a business that has a huge amount of customer loyalty amongst a certain demographic. So I'll be taking a good look at that one. Amongst the retailers, I haven't done enough work to comment. I'd say all of those ones that you listed there. Let me just get the list up. Lavisa, Adairs, Breville Group, CCX. All worth a look. And I'd add a few more to it as well.
And highly, highly volatile the last week in particular, right?
Donald's been listening from a hospital bed and needs to run, so I hope you're okay, Donald. Thanks for tuning in. We had a couple of questions here about, well, iSelect and Thorn, but a couple about iSelect that we haven't really talked much about, trading at 1/3 of the trail book value for iSelect, and similarly with Thorn trading at a massive discount to its asset backing. One of the earlier questions, this one's about whether it's an opportunity, but one of the earlier questions was about whether value investing is dead and buying these types of businesses you're never going to make any money out of. I think over the next 12 months, we are going to work out whether that is the case or not, because these businesses are under huge amounts of pressure to not just sit on those assets anymore. We've been having a fairly strong raging debate at Forager about whether this is good for iSelect or not, this environment. My view is that more people are thinking about health insurance. Some people feel differently about that, but it's probably one of the better placed businesses out there to navigate this environment. It's got its problems. There are no doubts about that, and it hasn't been performing as well as we would like it to be, but I don't think this environment exacerbates that at all. And in fact, it's very healthy net cash balance. It's got a huge trail book there due from insurance companies. I think it's pretty well placed relative to most to navigate this.
I've got another question here. Max has asked if there's a possibility for Thorn to run down the radio rentals book and pay a dividend out. They could shut down the stores and collect it. You'd agree, right? Possibility.
Lots of shareholders in retail companies are praying that their stores don't get closed down. We're praying that these ones do. I shouldn't say that too loudly, but honestly, you look at the quarterly cash flow statement for this business and the cash just keeps flooding in. And I think with the government stimulus that's going out there, there's no reason why it won't keep flooding in. And it's the cost based here that's problematic. I think the new management team is fighting fires on the other side of the business at the moment, and radio rentals has been performing relatively well, I think. So they're not turning their attention dramatically to it. But I think all of the shareholders here, I think the new board recognises that the long-term future for that business, at the very least, needs to be a very different business model from what it is today, if not one where we just try and get as much capital back as we can, or a mixture of the two. Now, if you shift this business to online plus some delivery services, do you get half of your capital back and also end up with a profitable business at some point down the track? I think all of those options are being explored, but probably not as quickly as we would like them to be.
Richard asks, what are you guys doing to stay on top of the research with regard to coronavirus coming from recognised experts? I think we're both spending a lot of time reading. I don't want to claim for a moment that we've played this particularly well from a market point of view. I think it was interesting that a lot of the people with numbers sense and understanding of statistics were onto this earlier than people with virology backgrounds. We had the WHO sort of really delaying calling this a pandemic, and I think there was people like Nasib Taleb that were saying this is a really, really concerning thing, and that was interesting. My chief advisor is my brother, who is a microbiologist and runs a lab, so I understand quite a bit about how the whole thing works. But yeah, we're reading all the same things that everyone else is at the moment, and as a citizen and as a human as much as a financial person.
Well put. There's a question here: if one of the stocks FOR holds as a fundraising, there isn't enough cash, could FOR see a fundraising? I'd say the chance of that are almost zero, given it's trading at a massive discount to NTA. Like I said earlier, we've got sources of liquidity in that portfolio, and we've got enough cash to fund any capital raising at the moment. People should keep an eye out for an announcement, hopefully announced very soon, but we are giving very active consideration to a buyback in that fund. Actually, I think if we get to the point where we're really happy with the portfolio and the units are still trading at a big discount, probably makes as much sense for us to be buying units at a big discount as the underlying holdings themselves. So no guarantees on that front, but we're actively working on it. And if we do it, we want it to be there as a it's not going to be a permanent every day we're going to buy back some shares. We want it to be there as an option for us if we think it's particularly attractive.
We've got a few questions. We've got a few questions about capital raising there, so I just consider those all answered for now. Yeah, go.
Do you see the market going up in the next 2 months?
Yes, and down.
I think. Go on.
So I've got an opinion on this. I think the balance of probability is where we're quite close to the bottom in time. I don't think the bottom here is 12 months out. And the caveat to that, of course, is unless this triggers a massive financial crisis and liquidation. I think the bottom is probably closer in time, whether that's 10% below today, whether we've already seen it, whether it's 50% below today, I don't know. But I would say I'm north of 50% confidence that 2 months from now will be up. I'll put it down. And if I'm wrong, it's just because it was in the other 45% probability.
Right probability, just bad luck.
Yeah.
This question, David says, what happens if there's a run on the FOR stock and everyone starts to sell? At what point or price is the whole fund likely to implode and we lose all our money? Look, there's nothing stopping the vehicle trading at a dramatic discount to its NTA, but it doesn't change our operation of the fund any at all. So to the extent that that happened, you're going to see the units change from the hands of people who don't believe in the future there to the hands of people who do. And if that happens at extraordinary prices, then it happens at extraordinary prices. Like I said earlier, I'm not for a moment shying away from the performance of this vehicle over the past few years. I think once the dust settles here and we see how some of these very, very beaten up stocks perform over the next 12 months, it's time to sit down and reflect on everything that's happened over the past few years. But our focus at the moment is making sure we've got enough of those. Well, we've got the portfolio with the right balance of stocks that are going to perform exceptionally well out of this.
Paul's asked, is the unit price for FISF at an all-time low at the moment? For FISF, that is. So the answer is no. We started off at $1 per unit back in 2013. We're in the 130s now, I would guess. And that ignores all the distributions that have been paid out. So no, not at an all-time low. Probably on a price to value basis, it's as good as I've seen it in the last since we started the fund. Anything to add there, Steve?
Well, we've touched on it a lot, but the market performance has been cushioned by the Aussie dollar depreciation quite significantly, not just over this recent period, but over the past 3 or 4 years. So, yeah, I would say in terms of unit price, it's probably only back where it was 12 months ago or 18 months ago, because there's been so much Aussie dollar depreciation in that. Is that not right?
I think it's around 2016, back in February 2016 when it hit lows. It's going to be around where it is now, I think.
What rough percentage of your wealth do you each have in the Australian fund and the international fund? Given the relative performance, I would say the percentage weighting for me has gone much higher towards the international fund. I started 50-50 and I have all of my wealth invested in our two funds. I've been chipping away a bit over the past 6 months or so in terms of my super fund, which is where most of my savings go, but fully invested as I have been for most of the past 10 years.
So of my wealth, it's a lower percent for me. Like Steve, I have a stake in the management company here. I also have superannuation outside. I have a big chunk of cash for buying a house at some stage if Sydney property ever comes in my direction. And I also have a caveat that I've been allowed to hold a few things, because when I started working for this fund, I was living overseas and it would have triggered some complicated tax issues. I'm now able to work through that, but I have some unlisted investments. I have some things that are outside. of my direct stock portfolio, Forager, the two funds is well more than 50%. Most of that for me is in the international fund. I do have a smaller investment in the Aussie fund.
We'll answer two more. We've been going an hour and a half here, so we better cut it off at some point, but we'll answer two more here. You have a small holding in ThinkSmart in the international fund. If you're considering looking at Afterpay, would not be advantageous to look at Afterpay via ThinkSmart and in turn it's holding in ClearPay?
Well, that's where we've been at. It was we've never been 100% confident about the value of our Afterpay when it was trading at $30. ThinkSmart was a very cheap option on a fast-growing part of its business. So just for reference here, ThinkSmart is a business that started a business called ClearPay in the UK, which was set up to be a copycat of Afterpay, got all the licenses, started developing relationships with retailers. Afterpay came along and said they wanted to start up in the UK, decided rather than go through that process themselves, they'd do a deal with ThinkSmart. I also understand that the trade name Afterpay had been squatted on, so it was a bit difficult for them to actually use the Afterpay name in the UK and Europe. So they did a deal where they sold, where ThinkSmart sold 90%, at least 90% of ClearPay to Afterpay, got paid in shares. ThinkSmart has liquidated most of those shares. They retain a stake in the ClearPay business in the UK. So it's between 6.5% and 10% stake, depending on how a few things fall into place.
I think there's two important points there, just from an investment perspective, though. Basically, ThinkSmart does not trade, so the liquidity there is almost non-existent.
Yeah.
And that UK business is probably the weakest, I'd say, of the Afterpay businesses, because they have a big competitor that's already established over there in Klarna. So it's not a straight apples for apples, and the ThinkSmart share price has hardly fallen, whereas the Afterpay share price has fallen a mile. So I think
Maths
the
was different a
trade-off
month
is
ago,
worse it was.
Yeah, correct. And then I'd say the UK market is higher risk, higher reward. That's probably fair.
Mm. And then, will there be distributions this financial year for FOR and FISF? Obviously, a lot of water to flow under the bridge before the end of the financial year, but highly unlikely, I would say, given where the performance is at. More likely in the international fund than the Australian fund, because we've sold a chunk of things that we made a lot of money on over the past year. But we create tax bills for people when we make distributions, so we don't actively try and maximize the distribution here, that's for sure. I know some people do like a little bit of money every year, and we are conscious of that. But to the extent that we've had losses over the course of the year, you probably should assume for safety's purposes that the distribution will be at or close to zero.
Should we do one more? I think
more?
we need to wrap up soon here. I'm sorry, I've completely underestimated how many questions we've got to get through. So anything we don't answer today, we will get back to you over the coming few days via email if you've left your details, or we'll find some other way to contact you if possible. Again, if someone doesn't feel that their questions have been answered adequately, please come back to us, and you can talk to us on the phone, or we can exchange views via email. You got one for us, Steve?
Maybe the last question there. Surely these are more uncertain times than the GFC. Not only has the psychology of the populace been destroyed, but it has stopped the economy with large unemployment numbers coming. Limited capital available worldwide to reverse this trend. That's the opposite problem to what we had 2 months ago, when there was supposedly too much capital chasing too few opportunities. Look, I think this is a chart, we didn't talk much about it when I was going through it, but these are previous bear markets, US S&P 500, because the data is much easier to get from there. Down 33 from peak to trough at the moment. I think there's 17 bars there since 1929 that are retractions of more than 20% over the last 100 years. It is not uncommon for markets to suffer significant meltdowns, and every single time it's a different reason. You don't repeat history exactly the same way every time, and every single time you're at the bottom of these markets, everyone is telling you that it's never going to get better and you can't recover and nothing's ever going to come right again. And it's the point of maximum pessimism when people are most worried about it that things turn and start getting better from there. There's absolutely no guarantee. You look at this bar and, you know, we're not to the far left there. This is far and away from the worst market meltdown stocks have ever suffered. So there's no guarantee that we're at the bottom here, but we're certainly closer to the bottom than we were, 30% higher. And, you know, I'm a firm believer that ultimately economies will recover and we'll get back to business, and people will be looking at interest rates and saying, I can buy the BHPs and Rios of the world on 6 and 7% yields, or I can earn zero in the bank. So once we get through this uncertainty, however long it takes, markets will begin to recover again. Okay, we'll wrap it up there. Thanks, Gareth. I really appreciate your time. Probably chat to you later tonight once European markets open, but thanks again for helping me out here and tuning in, and thanks for everyone else for listening as well. Thanks a lot.
Steve, don't leave the meeting, okay? Because we might lose those Q&As.